Hello everyone, today is February 11th and this is our session number 6 of the Wyckoff Trading course. Today we're going to jump into the volume and price analysis. This is something that I've been waiting for quite some time. Unfortunately, we can't do this right away. We need to be familiar with the price structural analysis first before we start understanding how volume influences the price. So this is where we are, and today is kind of like this transitional class. We're going to review the homework, but then we're going to go into the new material. Some of the notes, so usually I don't read a lot on the comments, but I want to comment on your comments. So if you had a chance to read this, this is great. Okay, so what's important here from the comments? Events phase analysis club with the wave analysis logic you discussed indirectly helped me identify a trade, few Wyckoff trading ranges in 530, 1-day, weekly timeframes. I have started seeing the price chart differently now, and that's what I wanted to get. Okay, this right here. I would certainly consider this as a major breakthrough. So this is exactly the time, and this is exactly the message that I should be hearing now from you. Because it's been already 5 sessions that we've been together. This is the 6th session. So this logic, the Wyckoff logic, or the logic that I teach you guys, should be seen on the charts. You should be seeing trading ranges. You should be seeing changes of character. You should be seeing extremes of the trading range. For instance, you know, like spring, upthrust, those type of the extremes. You should be able to label those extremes, label the phases with the trading ranges, and therefore when you look at the market, when you look at the stock, you should have a different type of way of analyzing this, and this should come now. So it usually happens in the second months. Thanks for overloading us. I need to know this stuff. It seems to be coming together more each week. Yes, and that's how it's built. It's built on layers, right? So today we're going to go into a new big layer, but still we're going to be building the new layers based on what we've learned so far. Still working on volume, supply, demand test, strong, weak hands, and this is something that is going to come more. So we definitely going to go into this material more. Okay, what else? Okay, so yeah, that's great. Okay, well, everything else is kind of thank yous. So, and thank you for thank yous. Yeah, I really appreciate this. And thank you for the comments. So I think that we're in a good place. And actually, I was really impressed with the homeworks. I think we worked really hard on labeling. We worked really hard with all of the homeworks that we've done, with all of the adjustments throughout the reviews. And now I see you guys are so good with this. I was really impressed with this week's homework. So thank you for submitting your homeworks. All right, let's jump into our session for today. So today, first we're going to review Apple homework. So this review will be quick. I would rather spend more time on the new material, and especially the group exercise that we're going to have here. This group exercise will take us probably 5-6 sessions, hopefully 5. So this is going to be a very, very big piece of knowledge that I'm going to give you guys through this exercise. We're going to start on the volume today with the volume and spread analysis. This is an essential basic that we have to have in order for us to understand the interpretation of the relationship between the price and volume. I'm going to give you 2 homeworks. homework 6, actually, why is it 1? 6, and homework 7. So homework 6 is going to be an easy homework. It's going to be just one chart type of homework, and it's going to be around the volume and spread concept. Then we're going to talk really quickly about the laws of the supply and demand, effort versus result. I'm going to give you my take on those. And then we're going to start that big group exercise. And hopefully we're just going to kind of like go fast through this. Next session, session number 7. We're going to continue with our group exercise. We're going to talk about the volume phase analysis. That is, what are the characteristics of supply and demand in different phases of accumulation and the distribution. And then, again, the homework is going to be a group exercise. By the way, speaking about the homework of the group exercise, one of the main assignments here is going to be to watch again and make notes. So I want to reiterate this from the beginning of this exercise. This exercise will give you a lot of knowledge, and this knowledge will be given to you also on the slides as well. But the most effective way to gain value from this knowledge is to actually watch the exercise again, make notes, and think about those. This has been a big educational tool in this course, making notes about this exercise. And from cycle to cycle to cycle, students are emailing me and saying that when they watch the video again, they are catching so many things that they did not catch during the class. So I'm going to reiterate this many times throughout the next 5 sessions. So you'll hear about this again. All right, let's review the homework. The homework was on Apple. And here, together with the homework, I'm always trying to give you some kind of concepts. Today's concept for the homework review is going to be about institutional value zone. And I forgot who exactly, but one student was asking me in the email, when are we going to be covering the value zone definition? And that's kind of like was so timely as a question, because this exercise, in a way, is kind of devoted, to thinking about the origination of this concept, institutional value zone. Let's look at the trading range first and the labeling on its own. So some of you have figured out that this whole formation is a trading range. And then some of you decided to maybe have a different interpretation and have a lot of small trading ranges identified. So for instance, somebody would be looking into this area, this area, this area, this area, this area, this area, this area. Both approaches are correct. Yes, we do see a consolidation if we would think about the climactic action, automatic reaction, secondary test that define phase A and the change of character relative to the uptrend that we have had in 85 to 87. If we would have bought the stock and then in 2004 have sold this stock, we would not gain anything. Meanwhile, there were quite a lot of deviations around this mean, right? And especially on the rally in 98, 99. So let's just kind of think about this a little bit. Is it possible that maybe the trading range was somewhere here? And I saw this in one of the homeworks. And I thought that was a very interesting idea. And actually, I kind of like this. just because I see how the texture here was different. It was more of the reaccumulation texture where we have a spring type action. The price comes down and then comes back really quickly in a very aggressive rally. And here we would be thinking it's a sign of strength. I mean, look how everything looks so good. There is not a lot of supply. There is demand that's coming up, increasing, and then the rally has the characteristics of a sign of strength rally. It's an increasing spread, increasing demand signature, and the price commits above. But it only commits above temporarily. So this pattern fails after the price comes back and gaps down. Let me show you a little bit better. So here is this gap right here. So the first failure is to commit not just by one close. The second failure is the return to the trading range. The third failure is the gap to the downside, and the fourth happens on the increased supply signature. This is not how the backing up action would behave. So therefore, this pattern fails, a pattern of what we thought a reaccumulation. So then we're going into another pattern here, right, or another texture. So this looks like a distributional formation, and it looks like a TP formation right here, where we have urgency to sell on the gap down, inactivity throughout, and then a pickup in the institutional capitulation on the way down. So it's right here where institutional trend followers are going to give up their positions, and that's going to produce this quick move to the downside. So everybody's out of the position. And then that, because of that, because the CO is out, and at the same time, you know, we are thinking the CO is out. ITFs are out, professionals are out, and public also is going to experience some pain here with getting into the position and then getting out of the position, you know, at the price of this triangular formation and then on the way down. So it just does not, this type of action and later capitulation does not produce a lot of demand on the way up, and that's why this rally fails. So exhaustion of both sellers and buyers at the same time. And then we're going into the oversold condition. I will come back to this and I will explain to you, you know, how did this come about. This is a little bit more volatile just because Steve Jobs is coming back to company, so that produced some institutional buying. We could see out of the deeply oversold condition, we are rallying really fast, and then giving it all up, and then rallying even better. So a news-driven volatility at the end of the down move. So what I'm saying is that I actually kind of like this labeling too. And the reason why is because we have a very clear commitment to the upside right here. We have a very clear commitment to the upside even without you know, the downsloping range. Even with the you know, bigger range, we still have a very, very pronounced commitment to the upside. And then something interesting happens. And those are characteristics, obviously, of the major sign of strength. Something interesting happens. We would be expecting a backing up action into this area, something like this. So what happens next? Well, 2000 in the market top. That's what happens. And then after that, we have the market in the downtrend. And the market, as I mentioned before, has so much gravity. It's just so you know, the sentiment of the overall market is going to dominate sometimes the sentiment even of the leadership stocks. and the leadership stocks are going to show some kind of weakness. Well, 2000 market was a really urgent market to distribute the stocks, and we had that a couple of big moves to the downside, big legs to the downside, very volatile. So that type of price action is going to create a lot of following. So therefore, a lot of the leadership stocks also going to go down. They're not going to go down as much as the market, but they're still going to have a pronounced move to the downside. So sometimes in phase D, we would observe this phenomenon. This is the phenomenon of a shakeout action. And usually when we talk about the shakeout, I want you to think about a bullish scenario, long-term bullish scenario, with the short-term oversold weakness, which is effectively a shakeout by itself. And that's what the shakeout is all about. And I believe that the current market action happened in the same way. It was a shakeout, short-term weakness, the price action in the long-term consolidation pattern, which still suggests that the US, even at this level of growth, is going to produce a better result than anything else in the world right now. And therefore, it acts also as a flight to safety, flight to quality, flight to defense. And even though the short-term picture, I think going into summer and into early fall, we're probably going to have a reaction. We're going to consolidate for quite some time. But then after that, going into 2020, if that growth is still going to be there, even at the current levels, we might have a continuation of a bull run. I've talked about this at the Market Watchers Live, this last Wednesday. If you have not caught that session, go to Stock Charts TV YouTube channel. And then the presentation is called 10 Questions About Current Market Structure. So, and my segment there was really small, probably like 20-30 minutes. So you can watch that. So this is just a phenomenon in phase D that happens sometimes, and with the stocks that are showing a lot of strength on the major sign of strength, and then the market happens, the market weakness happens, and the stock is being influenced. Just because the stock has had a lot of supply, it needs sometimes to retest it. So therefore, that concludes, that major last point of support area. So this is a very, very huge trading range, and somebody might be thinking, well, is it really possible from 1987 to 2004 that this is the trading range? How could we even confirm that, this was the trading range? Okay, well, one of the ways to confirm this is to extract the P&F targets from the trading range. So here I'm using a very old software which was called the Bullseye, and this software allowed to create this type of long-term charts. I'm not sure if you could do this in stock charts. I would be very curious to know. So here we are looking at the original trading range. Here is this major sign of strength. Here is this shakeout in 2000 that leads to the low LPS, last point of support. Here's our phase C with the spring. And what we would do with the P&F count, we would count from the right over to the whole area of where the trading range has started in phase A. And that gave us a target of 220. And we hit 200 and a half, I believe. Well, I would say that's very close. Why is this close? 20 bucks? Well, because when we are making a decision to enter this position, we are in the $6 to $9 range. So I would say that that is very close. For those of you who are curious, this area right here produced a confirming count. So that was also very interesting. And this whole move to 200 suggests that this whole trading range has been an accumulation. So now, and it has been kind of like a wholesome trading range, right? So if this is the whole trading range, then the biggest rally is going to be a major sign of strength, so we're confirming that. Then the next higher low is going to be a last point of support. And then whatever comes before as the lowest point is going to be phase C. And then before that, however you label this, everything is going to be fine. Well, the bias itself, obviously, has been given to us throughout the whole structure. That's why I refer to the Wyckoff analysis as a rolling over analysis. You kind of could see how the analysis develops, how the story is being created. And the story is really being created once Steve Jobs is coming back to Apple. This is where the volume starts to pick up a lot. And then look at the overall volume signature on the major sign of strength. There are bias all the way up to this area right here. It's only in this area where the demand started to go down. But diminishing demand does not mean that there are no buyers. Diminishing demand suggests that there are fewer buyers, but even these fewer buyers could push the price so significantly higher than the point of the resistance from phases A and B. So therefore, we're seeing that all the way on this rally, there is a lot of buying that's happening. And then obviously the market happens and there is a lot of capitulation by institutional trend followers. They capitulate at this point. At the same time, the CO is seeing liquidity and value, and the CO picks it up on the way down. And then the stock shows a lot of relative strength until this point where demand becomes a little bit urgent, it increases, and that pushes the price, to the new trajectory of a new uptrend. Now let's talk about the institutional value zone. So how would we define where institutions are interested in this particular stock? Well, we need to find the places where the price stops on what we could interpret as institutional buying, because it's the stop in action and subsequent demand that is being shown to us in that stop in action would produce a suggestion that some big interests are buying at this point of time, as well as any type of rallies off the lows that would have a lot of volume characteristics. So this is definitely where institutions are establishing their positions. Something like this could be observed in the behaviors not of just the CEO by itself, but also by institutional trend followers. They will be buying on the way up. Their buying will create the waves, the swings that we see on the chart. So here are the first time where the price fails and it's being supported of these two bars. There is some increase in the volume signature. So whoever was buying here on the way up was definitely giving up. But somebody was also buying at the same time. So with that, one of the highest volume signatures, we would be thinking that this is where the CO might be coming in and buying. And that CO, this type of the institution, eventually will be wrong about this position. I was making an argument with somebody this last week about the CO not necessarily being the CO on all of the trades. Can you imagine that institutions that we think that they are CO, like Warren Buffett's, that they make mistakes as well? I mean, like if you study Warren Buffett trading history, you will see that he has made quite a few mistakes. So we can't really say that Warren Buffett was the CO on all of his trades. He definitely was the CO in a lot of the trades, and in some, he was wrong, and he was weak hands. And he provided liquidity, and he capitulated on the positions. One of the latest positions that I could think of where he capitulated was IBM a couple of years ago, I believe. So we've talked about this in classes. But somebody is buying here, as well as somebody is buying right here on the way down, because they're seeing with all of this capitulation that some value comes into this area. So, and then throughout this whole range, this is where we're going to see, again, some elements of buying. Whenever the price goes below this level, we would consider this an oversold condition, and therefore, with the oversold condition, there is some value to institutions. And they would come in and they would start buying. So, for instance, like a bar like this, or a bar like this, and so on and so forth. And we would be seeing these bars with the increased demand signature. And again, it's going to take some time for institutions that we perceive as the CO type of institutions try to stop the price from going lower down, and yet failing every time. There is failure number one. There is failure number two. False starts. So here is where I don't want you to think so linearly. When we see a big volume signature, we know that huge institutions are coming in and they are buying. And we definitely thinking that this is the CO type of signature. But we know that even those big type of the institutions could fail. And they could produce a loss instead of a win. So those will become not the CO, but weak hands. And we just need to technically identify the areas where finally the buying by the institutional hands is going to prevail into the uptrend. But we could identify this zone. Here's the zone, and where it comes to the oversold condition, we would be expecting that there's going to be some kind of push to the upside. And then when it is oversold again with the new support area right here, this is again where we're going to see a quick rise to the upside. That would suggest that either supply is exhausted or there are some buyers and they're seeing this as a value and therefore they are buyers on this bar. Then again, as the price comes down, again we're seeing this sprint type action. So oversold condition of a true value zone will always produce this type of definition of how the price reacts in the V bottom, quick recovery, quick momentum type of buying, just because they're seeing value right there. All right, and then the next value zone spot for us is somewhere here where we see that a lot of institutional followers, trend followers, are giving up. So the CO is definitely seeing this as an opportunity to buy, and it's buying exactly in this zone right here. So if we finally see that instead of going lower and creating lower lows, the value zone is being respected. So by itself, it's a sign of strength. And then we're seeing the confirmation by the volume that there is an institutional value buying on the short-term liquidity and long-term value. They're thinking that this is a short-term event with the long-term prognosis to the upside. All right, let's go to the next chart. Okay, actually a couple of questions here. Thinking about this as a long-term trading range and taking your phase C and labeling it as shakeout instead of a spring. Is this correct or is this wrong? I think that if you will be referring to this support area that was created by the automatic reaction, then the extent with which the price came down into phase C could be interpreted as a shakeout. Having said this, this is not the first or the last point of support that has been developed by this trading range. And therefore, all of this spring and shakeout type of action will only be shown to us below any of the lowest support that we could see. So where are the levels of the support? First level of the support belongs to the automatic reaction. The second one belongs to the secondary test as a sign of weakness or a localized spring. So we're already thinking that if price goes down below this level, this is our oversold condition and not necessarily this one, the upper one. So with this logic, we're thinking, again, here is another one, here is another one. So it gradually goes down. The shakeout action, we really would like to see more of this quality, where there is no like a laborious move to the downside. This is not how shakeout happens, and this is exactly what's happening in this area, but more of kind of like a catapult wall down, where everything goes down. That's a shakeout type of action. So just the texture, the character of this is not of the shakeout type of quality. So therefore, this is just a trading range that we will label as a spring and a test. Next question. What is this software? It's already discontinued, so it doesn't really matter. Isn't it a down move on increased volume bearish sign right after 1991? Okay, so 1991, down move on increased volume, a bearish sign. This one right here? Yeah, of course. But you're thinking more as kind of like a public here. Because yes, it is a bearish sign, but for some of the institutions, this is going to be some value, and they're going to be buyers at this point. It doesn't mean that the price will go up from here. No, but we're just recognizing that this is the first time when they attempted to buy. So we want to see how the buying is going to happen at this level. And look what's happening next, right? So for instance, right here, this was a very important spot where the buying has happened again at the same point. So that reconfirms that institutions are willing and seeing the value here, and they're willing to buy. All right. Can we label automatic reaction as a shakeout? Yeah, you can definitely do this because, again, it doesn't influence your trade decision right here on the spring. So this could be a shakeout, automatic reaction, secondary test, and here's your phase A anyway. So it doesn't really matter that much. All right, let's go to the next one. So this was probably the hardest one. So I've seen a lot of the different interpretations, and I thought that, let me go through different scenarios here. Everything else was kind of okay, and that was so surprising. So I thought that the difficulty was more in the nuances, more in the in kind of like some details, some variations. Everything else, really, you guys just did phenomenal work with the homework. All right, so we've talked about an institutional value zone, right? So again, how would we define it? We want to find the first time when they are actually buying, right? So we don't see a lot of buying on the way down. So the volume signature is not increasing here on the climactic run, and that's fine. Sometimes that happens. It's just, again, a variation, which is different from what we've seen, let's say, somewhere here. In this case, the first buying happens and then no buying again. This bar right here reflects supply and suggests a move to the downside after a local upthrust. So we're really only seeing a buying around this zone right here. So if we would extend it, think about what happens next. On the way down here, we see the volume signature increase. This increase in volume spike suggests that, well, first of all, supply is increasing a lot, but there is also increase of the demand. And this increase of the demand we could see from the daily spread. The daily spread is actually diminishing relative to what we've seen before, right? So this gap down does not reflect the volume, overnight volume. This is only the daily volume. So on the diminishing daily spread with the volume spike like this, that suggests the presence of the demand, and not only the presence, but the increase of the demand. An increase of the demand suggests that absorption is underway. Plus, think about the character of this demand. There is so much demand on this bar, hidden from us, that it absorbs the supply, and we start thinking if the levels of demand are so high, this is probably an institutional demand. Where did we see demand before in this area? Somewhere here. So it makes a lot of sense that they are buying in the same zone. Because what's happening with institutions is that they basically define the value zone for them, which I'm calling it exactly like this, institutional value zone, and they are saying to their traders, buy me everything between 50 and 70. And especially I'm interested if the price goes below 50, because as a institutional trader, if you could get a position at the lower prices, that's even better. And what happens when the price goes below the value zone? It usually produces a very quick reaction from institutional traders because they see value and the price recovers quickly in the sprint type of manner. So this sprint is actually, this kind of like the analogy. Okay, I'm drawing this incorrectly totally, but it's a sprint, right? So it expands and contracts. You could push it together and then allow it to expand, and it will do so very quickly. The same happens in this spot. It really is a sprinting out of this short-term value position. Look at the next oversold right here. Goes down. What do we see with the volume signature? Right away, there is some demand that's coming in. Why? Because there is value for institutions. And this value is actually extreme because it's on the oversold condition. So how are they going to buy out of the oversold? They're going to be more aggressive because it's below their value zone. So see, here we are seeing this buying on the way up. And this buying is going to stop once it goes above their value zone. So somewhere here we are seeing already that more of weak hands are buying on the way up. And that produces some emergence of the supply from professional hands. Because professional hands are seeing this as a short-term overbought condition, and they're seeing this as a deviation from the mean. They know that the price will come back to the mean and probably will overthrow it again. So they're shorting into the weak hands liquidity at this spot. And then as the price goes down again, this action repeats. An oversold condition for institutions below the value zone creates a very quick pickup by institutions, and we see that again in the volume signature. And then overall, we definitely, trying to see, the overall increase in the volume signature relative to what we've seen in this area and in this area right here. We can see that there are so many more institutions that are participating in this rally. That suggests a beginning of a trend, and specifically uptrend. And not only that, institutional participation, and again, this is where Steve Jobs came back. Institutional participation suggests that this is going to be a long-term trend. So this type of moves out of the lows, cyclical lows or secular lows in the stock or in the market, with this type of volume signature that suggests that institutional participation are the best indications for timing for us for a very big move to the upside that is going to be cyclical in nature. And you could be thinking about different tactics there, how to trade it. You could be thinking about trading it as a long-term position. You could be thinking about trading it as a multiple swing positions and so on and so forth. Well, if there is an institutional value zone, then we probably would be thinking about some value zone for weak hands as well. Please note that I'm saying here weak hands just because it's both institutions and public. And how would we define the weak hands value? So obviously weak hands value zone is going to be associated with the distribution. If the institutional value zone is usually associated with accumulation, reaccumulation, then weak hands value zone is going to be a distribution or redistribution. So thinking about the concepts of the weak hands and where for the first time they will be excited about the uptrend. It comes on the last climactic run into the top of the market, into the buying climax. So we're seeing some buying on the way up in this climactic run, and we define this as an excitement or the first point of excitement by weak hands. So this excitement by weak hands produce weak hands buying into stop-in action. Well, why does this happen? Well, because CO is not buying. ITFs are in the position, so they're not biased either. They still do not provide a lot of supply to the market. So therefore, this is one of the spots where weak hands are going to do two things. They're going to be enjoying the profits. They're going to be profitable on the last leg to the upside. And then they are going to be also able to move the price up. This is one of the spots where public, or weak hands rather, can have a big influence on the price. So ability to move price up. So these are two attributes that are extremely important for us to remember at this spot for weak hands. Just because this is where they see the value. Now think about if they saw the value on the way up as the price goes down and goes below this value zone, how they're going to view this? They're probably going to view this as an oversold condition and a point of value to them. So what are they going to do? They're going to buy at this spot. So weak hands. And they're going to say that, oh my gosh, this stock has been so good in this uptrend, and I'm going to load up more. And if they have not been in that position by this time, this could be the first time when they get in. Now think about what has happened on the way down. A change of character suggested that the CO is selling. And also ITFs also identifying this as a trend failure, so they are selling as well. So the weak hands is effectively buying the supply from strong hands. And for a moment, there is a balance and absorption of supply, and that suggests a reaction to the upside, which follows. And in this whole reaction right here to the upside, counter to the change of character move, we don't see a lot of the institutional signature, and yet the price goes up. So that suggests that this type of signature is weak hand signature, and institutions were active or actively selling on the way up, on the way down, and then they are inactive. This inactivity produces a failed upthrust, which we could label as a secondary test. It's an attempt to upthrust above a buying climax, but we can't even do that. So here is a failed upthrust. And then there is some further capitulation by institutions, probably just ITFs. They are not seeing the trend. The stock for quite some time, multiple quarters, is not producing the result. Absolute result, and we'll have to think about what the market was doing at this time, and to see what the stock is doing. I would say that it's probably still outperforming the market at this point. Maybe that's just my guess. And then weak hands are still seeing this stop in action here as a value zone, and look at their signature. It's kind of mediocre, just because weak hands do not have a huge signature, volume signature. And then there is another failed upthrust, which we will label as an LPSY, just because this is phase C. Phase C actually has two LPSs. One of them is LPS as a failed upthrust, another one LPS as a test. And then out of that, we see in the TP formation or in the apex formation, a quick move to the downside, and then on the increasing volume signature. So that suggests a late institutional capitulation. Usually this volume signature will move us away from the trading range that we have had. Now think about, again, the weak hands value zone. As the price comes back to this value zone, what do you think weak hands are doing? They're getting more and more excited, right? Because this is where they bought before. In their minds, if I bought there before and the price was able from the lows to come back to this level, this is very bullish. So I'm going to be buying again. So into this buying by weak hands, and we see an excitement with each of the rally, with each of the thrust to the upside. So multiple upthrust situations, 1, 2, 3, into the weak hands value zone. And every time it happens, institutions are selling on that excitement of weak hands. So there is increase of the supply here, increase of the supply here, increase of the supply going into this area right here as well. And institutions know that for them, the bias is to the downside, and they know that at this point of time, this is an overbought condition, and they are looking for short-term liquidity, which is being created by weekends, by the excitement of weekends, and they just sell into this excitement. So that produces more sell-in and so on and so forth. All right, let's go to the questions on this. Third trading range, phase C, not a spring as a question. Well, I don't know if you guys could see this, but this low is just ever slightly a higher low, and it's not a lower low. So with the higher low, we definitely would put last point of support rather than this spring. We could label this secondary test as a sign of weakness as a spring type action. We could do that. We could label this whole thing as a phase C. Sometimes phase C would have this type of, spring and then the test. And I'm thinking about this. I would probably relabel this now. I would probably just label it like this, phase C. So then a spring and a test. But this one right here is a higher low. All right, first trading range, phase C, failed upthrust, not upthrust after distribution. Okay, guys, so this is one of the things that I want to talk to you about. So it's very interesting. For some reason, this group was like this. So what I really would like you to do is to make sure that you go and you study all of the concepts that I taught you guys, because sometimes I feel that something that was taught and we're coming back to the same question because people just don't kind of like go and study this material. This is awfully inefficient. So I would really urge you, to study all of the Wyckoff events, the sequence of those events, how they come and the characteristics. So a question about the upthrust after distribution. So think about the question itself, right? So we're saying that there is an upthrust after distribution. So just after distribution part is definitely okay, but the upthrust is not. Why? Well, because we don't really have an upthrust here, right? How do we define the upthrust? We define the upthrust as the price overcoming the resistance, temporarily committing to the upside or attempting to commit, and then falling back into the trading range. Do we see this type of action on this high? No. We are failing. That's why the labeling here is a failed upthrust. Do we do this on the next high? No, it's a lower high. So again, we cannot overcome it. So we can't really label this if an upthrust after distribution just because definitionally it's incorrect. So I would urge you to make sure that you understand in what kind of, very simplistically, if this is going to be a higher high in phase C for the distribution, this is going to be upthrust after distribution. If this is a lower high, then it's always going to be a last point of supply. You can remember it like this. But I want you to remember, because this is the second session where I kind of see this tendency. So, and I definitely want to go away from this. First rally into the buying climax. How do we know that CO is not buying? So I'm assuming probably right here, right? So how do we know? Volume signature by itself, not that big, right? We also would be thinking if this is a sign of strength. So we want to see some kind of urgent buying by the CO and something maybe like this, right? Where the signature is so consistently increasing and there is some urgency to get into this position. This is more of the technical rally where the volume does not fully confirm what the price is doing. And that would be our first guess. But then we could just say that, well, maybe they are buying. And then we can only know that they were not probably on the next change of character that falls into the range. So we could make a mistake there, an interpretation that would be erroneous. But I think this mistake you could quickly correct on the next reaction, because you would be thinking, why is it that the volume signature increases so substantially over what we thought the institutional buying? That should produce some kind of hesitation and thought there. All right. Okay, so from Eric, let me see, Ramon, in the second, I'm trying to see the whole question. Okay, here we go. In the secondary distribution trading range in 1995, we have an upthrust of the distribution below the resistance line. Bruce Fraser in stock charts define phase C with LPSY in one of his distribution schematic when price does not go up. Why label upthrust of the distribution instead of LPSY as Bruce? Well, I think that you are misreading what Bruce is saying. There are two types of again, we're kind of repeating this, but okay, let's just stay here. Let's just stay in this space. So two types of phase C that could happen. So you have to be extremely careful how you refer to Bruce's work, because I'm sure that Bruce would agree here with me. Phase C as a lower high is going to be labeled last point of supply, like we've labeled it here and here. In a different distributional pattern, where we're going to have an upthrust of the distribution, and this is going to be a higher high. A higher high is going to be labeled as an upthrust, but because this is a distribution of the distribution, this is a legacy name, as I mentioned to you before. So these are the two types. And these are the only labeling that the method has presented to you. So I'm sure that, you're probably looking into one of the other schematics, which Bruce has shown. So Eric, please come back to that particular blog by Bruce and reread it. I'm sure you just, remembering it incorrectly. And if you find it with the different type of labeling, just email me the link. We'll be very curious to see if that's true. Okay. All right. Let's kind of go away from all of this. I'm feeling that we need to speed up a little bit. Okay. So next chart. This is also, one nuance here for this particular chart. You could take the whole formation here and just say that this is our phase C, this is our phase A, this is our phase B, and then we have a very prolonged phase D. That would be acceptable, absolutely. You could also think about two trading ranges, first trading range and then a second trading range. And I forgot who it was, but a couple of people actually did it exactly this way. So that makes a lot of sense to me. Why? Because I see that the texture here is somewhat different. This is a leadership stock that is being distributed on the way up. And then after a major sign of weakness, we're seeing that the texture is somewhat different. Let's talk about upthrusts here so that we would not confuse again, the labeling. So we are definitely showing an upthrust here, right? Because we are overcoming a resistance and then we are coming back into the trading range. So this is an upthrust because this is a distribution. This is an upthrust of the distribution. The same thing here. We're seeing a higher high. A higher high will be labeled in the distribution or redistribution as an upthrust of the distribution. A lower high will be labeled as a last point of supply. if we would have had a lower low, let's say after this upthrust right here, and we would have something like akin to this, then this point would be labeled as last point of supply. If we would have had a failed upthrust that does not overcome the point of the resistance, and this becomes a lower high, then we are definitely labeling this as a last point of supply. So Eric and Philip, please make sure that you come back to the material, reread it, and understand why we are labeling this way. Okay, so another point right here, was the question of why such a big gap. Eric, but yes, I see that you got it. I understand that you got it, but my point is not that. My point as a teacher, I want you to learn the stuff that I'm giving you and not to re-ask the same question. So that's kind of like a point that I'm trying to make. So I hopefully, you'll kind of like appreciate the thought behind this, and because it influences the whole class. The question of why such a big gap? So let's think about what is happening here. And I know that a lot of you are going to say, yes, it's an institutional capitulation and liquidation of their position. But the question is not about why institutions are capitulating or why the gap has happened. The question is more of why a big gap. So I wonder what you think about this. I think that I've given you enough logic already throughout this, 5-6 sessions. So write it down. Write down your thoughts, guys. Let's kind of speculate here. Why do we have such a big gap? And big is, kind of like what I want to hear from you for the reasons of why. While you're thinking about this, let me go really quickly through the weak hands value zone. So thinking about that this is a distribution, we would be thinking about weak hands seeing some kind of value zone and being buyers, right? So where would they be excited first for the first time? Into the climactic run, right? So all of this movement is going to be weak hands first point of excitement. And we could see that weak hands operate here. Why? Because of the volume signature. It's insignificant, and yet the price runs up. So it tells us that the CO is still holding on to the position and does not provide a huge supply to stop the price from going further up. And weak hands are in control of this market. Institutional trend followers hands, they're still in the position, they're enjoying the run, they're making more money, but they're not distributing because the definition of the trend was not violated. So we see from the volume signature that this is definitely weak hands operating at this point of time. So therefore, their value zone is going to be somewhere on the last run into the buying climax, where we see some kind of not substantial buying. And it happens with all of these bars right here. And then throughout this structure right here that looks like a reaccumulation in the distribution, we're going to notice how the testing is going to be done and how the buying is going to occur also at the specific spots. And we want to catch this buying as a value zone as well. And then extend this value zone throughout this whole zone. So thinking about the value zone, we obviously will be thinking about the overbought condition and the oversold condition. So every time we're going to go into the overbought condition, the behavior of the institutions and the composite men are going to change. The composite man is going to start selling. That will produce a reaction. On this reaction, we could see some kind of violation of the trend. with this violation of the trend, we will see capitulation by institutional trend followers. And this capitulation is going to be early capitulation. And it's going to be not substantial. They're going to capitulate around this area right here. But we're seeing from the volume signature, how much did they capitulate? Did they sell a lot? Probably not. At this point of time, Apple is a very hot commodity. It went up, I think, ×5, if I'm not mistaken, off the lows in 96, even probably more. We could look at this on the first slide. So what do you think institutions are doing here? They are unwilling sellers here, and they're probably just slightly scaling out. So we don't see a lot of institutional selling. And that happens throughout this whole trading range. Look at the volume signature, right? Obviously, because of this spike right here, we can't really see a lot, but we could distinct that this was the area of where selling has happened on the way down. This is probably just early institutional trend following capitulation. CO has been selling, throughout. And once the price, please note, once the price comes back into the close to the overbought condition, what happens? We're going down, we're going down. Now back to the question of why such a big gap. Well, usually CO and institutional trend followers are going to start selling in a kind of sequential way, right? So they will sell into the buying climax, they will sell into the change of character, they will sell into the highs of phase B, they will sell into the phase C, they will sell on the major sign of weakness, and then they're going to repeat this process over and over. But there is not really a lot of selling here, just because the price stays up. Think about also what's happening in this area in the market. So the market had topped in March. And then it had a very big decline into August, September. So think about how Apple is being seen in this moment of the market history. It definitely seen as a defensive stock. Why defensive stock? Well, because it doesn't lose value and it doesn't lose relative value. The market is going down, so relative to the market and to the peers and to a lot of the stocks, Apple is at the point of value for a lot of institutions. They are not giving up this position. So when the price starts to capitulate, and obviously that could happen on some earnings and on some events, this is where they're going to capitulate. But because of how quickly from the value zone for a lot of the institutions that became weak hands by holding the stock, and it drops so much, what do you think they're going to do? They're going to capitulate. This is the event where they're saying like, okay, I'm done. I'm going to go away. So take me out at any price. And that's why the price drops so much, because the demand to sell is so huge among institutions overnight. It opens up with the gap, and then so much selling that is happening at the same time during the day. Now somebody is already buying. There are buyers on the way down all the way, because they are thinking at this price relative to where it was, this is what, 50% down, if not more. If the stock looked so great at these levels, why wouldn't it for the value investor look great at this level? Obviously, this is not our trade because we are technical traders. What we need to do is we need to figure out how the emergence of the supply will be tested. And until we actually break the downtrend and create some kind of change of character, we can't really make any assessment of this. All right, let's look at some questions. Let's look at what you guys wrote. Okay, CO distributed its position. Yes, so CO, ITFs, weak hands, everybody capitulates right here. So this looks more like even a general capitulation rather than just like CO or ITFs. Everybody's capitulating at the end of the time, at the end of the point. Jory is making a comment, end of the quarter. Yes, also one of the things in the bad market. Yeah, so I think it's a market that just that this stock, you have to think within the context of what was happening, right? So right away, I'm giving you all of the data for the market on this chart, even though the market is not here. I'm giving you the time. You should remember what has happened during this period, and then you can create the whole story as to why this gap happens like this, why it's such a big gap. Okay, from Nilesh. I marked these charts with 2 upsloping trading ranges as well, but my boundaries are slightly different. I often get confused around which points to connect for sloping trading range to mark boundaries. Is it more visual range or precisely connecting specific points? This is a good question. So we definitely want to identify the resistance points in phase A, which will be a buying climax, and phase C, which will be as a higher high in the upsloping structure, right? We are only discussing the upsloping structure. We always will have higher high in phase C. Or maybe we'll have a lower high and then, a higher high in phase B, something like this. So we're always looking for these 3 points. Points of resistance in phases A, B, and C. And then we are trying to connect them. And only after that, we're looking at the automatic reaction and any type of sign of weaknesses in phase B to extend the parallel lines. So that's what I did here. You could potentially also identify, maybe this highs as well. But as you could see, this is just another parallel line to the one that we've created out of the buying climax and upthrust right here. This is just another level of resistance, another level of support. And then the second one, I'm taking here phase A and phase C. Please note how phase B has this upthrust action above this resistance. Why I did it like this. Again, phase C is extremely important low right here. And also, obviously, yes, there is some kind of visual attempt to fit the definition as well. And I think that you have to understand to what reasonable extent you can do this. What is that reasonable extent? Well, seeing that significance of this highs connecting on the same level, and then seeing the significance of this low oversold condition, and then look at how there is a commitment and then attempt to rally to the same level. So quite a lot of concepts that fit together in this upsloping range. And then obviously the upthrust action is just an upthrust in phase B. All right, good question. All right, let's go even faster. So here are a couple of things that we need to discuss. Obviously, institutional value zone, we just looked at this range. We looked at how the buy-in came on the daily chart right here. This is definitely a lot of value on a short-term basis, a lot of liquidity. Again, coming out of this zone, now the price is cheaper and there is a lot of value for institutions. Please note that every time it went below the value zone into the oversold condition, the price recovered really fast, really fast. And only in phase C, this is where we see that the demand is inactive. And until it starts to emerge again, and there is some kind of institutional accumulation on the way up, and we see this from the volume signature, only then the price will start moving up, because this demand emergence will produce buying, and buying obviously will produce the momentum up, and that will push the price up. And again, we're talking about the concept of emergence of the volume first, specifically increase of the demand, with the movement of price up. So we kind of seeing how the result to the upside is following the demand signature. So that's the first condition. So this, the absorption and this movement of the price obviously will be shown on the increase of the momentum. The price will start moving and it will start moving faster to the upside. That will show a relative outperformance. So, and it's very interesting to observe how institutional clients are always talking about this thing, the third one. And in effect, I mean, we're teaching you the same thing, guys, right? Because relative strength is extremely important as a subject. It identifies, the outperformance, so it suggests institutional buying behind it. But if you think about the origination of the relative outperformance, it comes once the momentum is increasing, and it comes after the emergence of the volume signature that would suggest that the demand absorbs the supply and is capable of pushing the price up. Only when the effort and the result are synced, that's when everything else is going to happen. So kind of interesting how it's being all interpreted. What else? There were quite a few labelings like this with phase C right here. I don't have any problems with that either. Because if you're taking the position in this area, you're still profitable for many years ahead. The only thing that I would mention is that this area right here has its own texture. So look at the price, how it behaves. Look at the volume signature as well. Everything is kind of like of the same type, of the same texture. We have a stop in action, and then we have the volume on the way out. Sometimes this type of volume activities define the ending of a downtrend and the beginning of the uptrend, or they define the boundaries of the whole trading range. You could also think about this in much larger terms. Look at this volume signature right here. It defines the beginning of the trading range. Look at this volume signature here. Defines the beginning of an uptrend. So the volume signature emerges sometimes at the points where there is a very aggressive absorption in the points of the liquidity, where everyone's panicking, or where there is now a shift in sentiment from bearish to bullish. And a lot of the institutions are trying to get into this position as soon as possible, and the urgent volume signature or the urgent demand signature occurs. All right, here's the same trading range, only on the daily. This is that big phase C that I've labeled. So let's look into this really quickly. We're seeing that there is a lot of buying here as a stop in action. Then there is a lot of buying here on the way down. So that kind of defines that value zone where institutions are buyers. Look at every time it has a pop up like this, a sprint type of action. Once we go into the oversold condition. Isn't it great to understand what sprint is all about? And then once you see that, you know that every time, if this is a true accumulation, then every time you have an oversold condition, you have some kind of attempt of the price to come back and, you know, to return to the trading range, return to the area of the resistance. And hopefully on one of those rallies, like this one right here, the price not only will come back to the trading range, but overshoot it, overshoot the value zone, commit to the upside, and then react into this area of the support. Now, something even more significant has happened here. There are two things that we could see from this area where, excuse me, sorry about that. All right, I'm back. So there are two ways of how institutions buying in this particular area. They are buying on the way down. We could see this from the volume signature. This volume signature increase suggests that yes, supply is increasing and supply is still dominant over the demand. But at the same time, we already see that demand is behind this volume signature as well. And demand is not only present, but it's increasing. Therefore, it's not only the increasing demand, but we see from what has happened afterwards, it's a stop in demand. And therefore, we're concluding that this could be an institutional demand. And then we see a different type of institutional demand. It's the demand that produces this type of move on the way up, where demand signature is extremely high, volume signature is extremely high. That suggests an urgent institutional accumulation on the way up. And think about the urgency. What does it really even mean? Urgent demand. That probably means that institutions are seeing so much value currently that they want to get into this position and just stay in this position. And I want to get in at the lowest price. So that's why, because a lot of them are trying to get in as they see this, value proposition, valuation of the stock somewhere higher in multiple years. They're trying to get in at any price. They don't really care. Okay, so what else here? One of the interesting things is just this phase C definition. So the thing about this is, it could be interpreted in so many ways. I mean, I could see that somebody would be saying that this is a buying climax here because there is a climactic run. I wouldn't argue with that whatsoever. But I also could see a climactic run here. And obviously, I'm looking at this reaction right here and comparing it to all of the previous reactions. And this looks like a change of character. If this is a change of character, then this is phase A, and we are in the trading range. So therefore, the next move up may be just a definition of a strength that suggests a reaccumulation rather than a distribution. But we still would be thinking that this is an attempt to retest the previous high as a secondary test, upthrust action, just because we overcame, committed, then came back. So then think about the number of tests, right? So test number 1, test number 2, test number 3. And test number 3 happens as a higher low. Could a phase C have this type of characteristics? Yes. What should happen after phase C? Well, we should commit above the resistance that was created in phases A and B, and now everything should click at this point. And committed in a specific way. We want to see sign of strength characteristics. What are those? Increase in volume signature, increase in spread, and we see both of those. And relative to the previous rallies, it's definitely much, much better. Plus, on the major sign of strength, we're committing above, and then we are reacting exactly to the area of the support. So phase C might not be seen right away as phase C. The tendency is going to be to label this as phase C. And even that is going to be sufficient, just because if you think that this is phase C, your point of entries are going to be all around this area, which is the area of where we want to come in and establish the position. All right, let's come back to questions. Second trading range, late December marked as a spring. Can it be right here, I'm assuming? Again, if you think that this is phase C, then yes, the proper labeling would be a spring. Now in this case, because I'm labeling this as phase B, in phase B, we are going to have sprint type actions, but not sprints. But this is just relative to this formation, to the local formation, you could label it as a sprint. But relative to the whole trading range, then this action in phase B is going to be interpreted as a secondary test, attempt to retest the previous low as an automatic reaction low. All right, let's kind of see what else is interesting here. Yes, on this chart, a lot of you put phase C right here. So this is a little bit difficult here just because this is an apex formation. It's not your usual horizontal range, but you have to apply concepts. And that's why I ask you guys, please go to the schematic. Please go to the explanation of all of the Wyckoff events with the characteristics and think conceptually. How would we do that? A move to the upside, it should end somehow and somewhere, right? Where is that stopping action? Well, probably here. Why? Well, because we experience the biggest reaction after that. So most likely, this is a change of character. If this is a change of character, this is phase A. If this is phase A, then this is an automatic reaction. Then the next attempt to go up is going to be a secondary test. It commits above by one close, so an element of an upthrust. But because of the character of the change of character, right? So it's not that robust to the downside. It does not retrace more than, it doesn't go to 1/2 of this previous move. It looks very bullish. So therefore, upthrust action, because we're thinking that this is still a reaccumulation. Plus, it also happens at the level of the previous more significant climactic action. So we're thinking this could be a major sign of strength and then a major backing up action. So as we've defined phase A with all of those elements, then we want maybe to think about either the number of tests, which is 1, 2, and then 3, and then think about other concepts. In apex formation, we will never see a very prolonged backing up action. We will never see also a very long major sign of strength. It's going to look exactly like this. It's just a slight commitment to the upside, quick retest, and then off we go to the races. Just because of the apex formation and the characteristic of that apex formation. usually in the apex formation, a lot of the volatility is going to be in phase A or early phase B. This is where the institutional rotation will happen. With this institutional rotation, we are going to see the exchange of shares between strong institutional hands and weak institutional hands. And then after that, into the apex formation, the volume signature is going to diminish significantly. This is where SEO is inactive. And this is where trend followers are inactive as well. And this is where also weak hands are somewhat inactive too. So we have that diminishing volume signature. And it's only on the breakout, this is where some of the institutions are going to see again some value, probably on some event, and they're coming back in, and that creates that momentum, that push that takes the price out of the apex formation. In here, let's just quickly look at the value zone. Look at this trading range. So there is some pickup, institutional pickup on the way down. There is definitely a lot of buying here and then on the way up. So this defines this whole value zone. And then as we go down, this looks more like a shakeout. Should not be labeled as a sprain. It's labeled as a sprain just because of the downslope. But if we're looking at the horizontal range, like this one right here, this is definitely the character of the shakeout where we have multiple closes committing to the downside. It's a significant move to the downside. What else we don't see here is that, you know, the volume signature has not increased that significantly. So that could make as an argument for the sprain. But then an oversold condition where it's quickly comes back to the value zone and then overcomes it. And those value zones, they change, right? So from one level, they go to the next level where we see a lot of institutional buying. And again, in the range where we go into overbought condition, what's going to happen? Professionals are going to sell. Where we go into the overbought condition, there's going to be an attempt to sell. Where we are, well, we don't have an oversold condition here, but here was an oversold. So a quick recovery. Okay, quick questions. Second trading range, late December. Oh, I think it was a different, it was a previous slide. Okay, second trading range, secondary test as an upthrust action. It has price action and volume signature as buying climax. I understand your interpretation. It's just curious. Yeah, it has those characteristics. But this type of characteristics are not just necessarily going to be present at the buying climax. You could have different other spots that would have expanding spread signature, expanding volume signature. Excuse me. So my logic here was just based on interpretation of the change of character and the stopping action of the buying climax. But if you would put it here, buying climax, as I mentioned before, you could label it in a different way. Yeah, you could probably think that this is phase A right here, and then this is B, and then this is C again, and that would be okay. Again, the labeling does not really matter if you're making a profitable trade. That's the whole purpose of everything that we do here. All right, so what do we have on time? I was kind of thinking that we're going to go into 6 o'clock today, so we still have some time. Okay. All right, so this one was somewhat easy. A lot of you guys just kind of like nailed it everywhere. I like that a lot of you put here phase C right here. Again, we are talking about an attempt to upthrust. And just because it creates a lower high, that's why we label this as a last point of supply and couple of tests into the supply. Into that last point of supply. Major sign of weakness. Look how in the downsloping distributional range, we are seeing a commitment to the downside and then attempt to come back into the trading range, and it comes exactly to the point of the resistance that acted before as the sloping down support. So all of the concepts are there. They're all correct. Okay, well, it is definitely a very interesting Wyckoff story here, but I think that maybe we'll skip this for today. Look at this value zone where we are seeing that a lot of institutional buying has happened in this area. So where is the price? It's right here in this zone. So that defines that institutional value zone for us. Anything below this is oversold and will be quickly bought in by institutions. Look at this. Look into this. And we kind of could see how these 3 points are creating a sprint type of action just slightly below that institutional value zone. So that's kind of like a true definition of a sprint to me. It's an oversold condition below an institutional value zone that produces a quick absorption of the available supply below this zone, and that brings the price back into that zone very fast. And that's exactly what we're seeing here. Another interesting thought here is that look at the volume signature. Once institutions are in this position, they just basically don't buy. They consumed, absorbed all of the supply available, and they're just waiting. So as the price retests the lows, every time in the oversold condition, there is some kind of small pickup of the supply, and that absorbs and kind of concludes the absorption process. That absorbs whatever is left to what they already have bought, and they have bought so much that at some point supply is no longer available, and even an inactivity by the CO produces a move up just because supply is so low. So this is a very important point. We will come back to that on other slides. All right, here, okay, guys, I think that what you'll do here is let's just do this on your own. So let's do a self-review. So this slide, okay, so this one is interesting, and a really good question from Nalesh. Let's go first through the distributional weak hands value zone. So we know into the buying climax, the first point of excitement is going to be by weak hands. It's going to be on the climactic run, which is this. So, and we see that from the demand signature, and we define the zone throughout this whole range. Now, the question that was asked by Nalesh is, at what point do we need to consider this as an upward sloping trading range? Because originally, this is what we would be thinking. And originally, that's how I labeled this range when we had this change of character that was well defined with the increase in volume signature and the biggest reaction in this upswing that we have seen. That suggested a non-consolidating environment, a trading range, and the question that Nalesh is asking is very important. At which point would we be thinking about upsloping structure rather than more of the horizontal structure? And I think that we would be thinking here, and I think this was another question from somebody, or maybe in this question, we could see this. Would we be biased here? I think that without, thinking too deeply about this, and by deep thinking, I would be thinking about what were our original targets. And actually, the original target suggested exactly the stop in action somewhere in this area. And those type of PNF targets were off 2008, 2009 trading range. So that's a big trading range right there. So if we are in the vicinity of these targets, we should be extremely careful, and we should be stopping, listening, watching as to what the price and the volume is showing us and telling us. Having said this, it seems that this area has the texture of the reaccumulation. We see multiple tests on the diminishing volume signature, that the tests that are higher lows, and we have higher highs, local higher highs. So that looks constructive and bullish. This reaction right here that has some volume signature does not produce a big result to the downside. It's diminishing as a result, which is bullish, short-term bullish on such a big effort signature. Also, it stops exactly at the first point of the first automatic reaction. So that's also a good symmetry, bullish symmetry for us to see. So I wouldn't mind actually, having a position or thinking about establishing a position at this spot. So somewhere here on the breakout, that's another possibility. And then once you are in this trading range, you're probably going to close out this position here. This will be your exit. So you guys kind of could see that my strategy is not necessarily to be correct every time. My strategy is to be sure that I'm going to see the opportunity and I'm going to use this opportunity. Obviously, on a much deeper level of thinking, I mentioned the target zone right here, and I mentioned this really briefly. But this was a very consistent sell-in right here that should have produced some kind of hesitation. But the actual recognition of this pattern came right here. And the reason why it came here, in this, on this reaction or on this failure, is because we're still talking about a leadership stock that has a structure of the distributional structure of higher highs, higher lows. And those are going to have a lot of reaccumulation characteristics in phase B. So it's extremely hard to figure this out until it actually shows itself on a change of character out of the trading range. But if you train your eye to recognize this failure, so there is no continuation up, there is a failure, then somewhere here in this zone, you could change your bias. And that's what I do with a lot of stocks. And I've shown you guys with Navadir just recently, where Navadir has been such a leadership stock. I've tried to short Apple in this campaign to the downside and kind of like picked up just, was correct on the bias, was, too premature to exit. But the concepts are the same. Leadership stocks are going to be distributed in a different way. And you have to sometimes change your bias on the change of character after a new high. And sometimes it's extremely difficult to do just because mentally it's hard to do. Now look what happens with the weak hands value zone as the price falls and comes into the oversold condition. First of all, the recovery is very quick. that suggests that still there is some kind of value to some of the weak hands at this point of time. And then look at the second rally. It comes exactly to the point of where weak hands were starting buying. It excites buyers because they are thinking that this is an oversold condition. And then institutions are just selling into that excitement. Both of the rallies have that excitement characteristics behind it, and in the way how the price moved. And then on the way down, we're seeing that late institutional capitulation, it coincides with the institutional value buying on short-term liquidity and long-term value. So in other words, why is it so confusing? Why are we using institutional in both cases? Well, the drop to the downside kind of suggests in the volume signature that institutions are present. They are sellers at this point of time. Or rather, I should say, specific institutions are sellers. And then other institutions at the same time are buyers because they are seeing some value. And they are saying that even so early on in the process of establishing a new low, establishing the new accumulation range, we are willing to come in and to buy because there is so many stock shares that are available at this point of time. So they will do exactly that. And this is where we would put that first initial value zone. And then every time we go below that oversold condition, we quickly recover. Go below that oversold condition, quickly recover. Go below, quickly recover. And on the recovery that takes us throughout the whole trading range, that's when we are identifying a major sign of strength, changing of the environment from a trading range to the emergent uptrend thing. And we only need the confirmation by the backing up action. Now look how the price comes back into the value zone. And again, that creates what? An oversold condition, but now an oversold relative to the price that is above the value zone. And again, it acts as a spring type of price action where the price goes below the support and then quickly recovers. Why? Well, because somebody sees value and picks it up. Somebody was seeing value here and then seeing more value even lower. And that should kind of trigger your thinking about, actually not there, sorry, here and here. This type of the decline into the value zone and the way how it recovers so quickly, you should be thinking that the volume increase suggested that there is a lot of demand that is coming in. First demand was absorbing the supply, and then the second demand was absorbing whatever was left. And because supply has diminished, the absorption was faster and the price recovered pretty fast. So think about that type of logic. If you are thinking this way, then you might be even coming in into this position here. Because you might be thinking that if this is an oversold in the backing up action, this could be the lowest low in that backing up action, which it was. So, and it could create some kind of like maybe apex formation, and this low is going to be the lowest low. So we want to start thinking this way. Okay. All right, so this one is going to be for your home review. Let's do that. All right, so now let's talk about the volume and spread analysis, and we are 10 to 5. Okay, great. I want you right away to concentrate on one idea and one idea only when you are looking at the volume and spread analysis. And you probably have seen it from different sources, different software sources. So the biggest mistake that I see students do with this material is that they see the signal. They could interpret the signal, but they do not look into the context of where this signal occurs. In other words, you need to understand the environment that we are in and then look into the VSA signal and interpret this signal relative to that environment. So let's look at that. And we're going to start with basics. And this comes actually from one of the Hank students, Jerry Blythe. He is an MD, and Jerry has taken Hank's classes many decades ago, and he has created this kind of like, a small spreadsheet references to the volume and spread and the way how they behave. So I'm using this first slide just to give the credit to Jerry and also to go through some general considerations about the spread and the volume. So let's look into this. So under the spread, the increase in spread would suggest that there is a little resistance to the price progress. Decrease in spread would say the opposite, some resistance to price progress. And then the average is going to just express the normal trend of price progress. Volume is going to be much more difficult. General considerations. Usually, volume is going to be associated with the force behind the power. So we usually would think about the effort behind it. Volume usually expresses the quality of supply and demand, and we'll talk a lot about this because we will be creating those volume equations with the supply and demand. Increase in volume in general is going to be usually suggesting supply. That's number one in a lot of cases. But then also it will, in some cases, will show the emergence of the demand. And we will just need to be aware in which environments, in which context we're interpreting that signal between the volume and the price. A very heavy volume usually is all about the supply, but sometimes there's going to be an urgency to accumulate, and that's going to be an absorption on the way up on the major sign of strength. And we've seen that. A massive volume signature usually will indicate the climactic action. Decrease in volume signature would always, we'd be thinking about lessening of the force. And then a very light supply signature is going to indicate, and I think I should take this down. This is actually not necessarily correct. Okay, so let's just keep it like this: increasing, heavy, massive, and decreasing. So those are general considerations about the price and the volume. Now let's look at specific scenarios. And I've created this slide for you guys so that you would print it out. And this is when I say print this out, put this in your library, I mean study it, have it in front of you as a reference, so that we would be on the same page. So one of the things here and about the volume and spread analysis that I'm keep repeating is the context. The context is going to be the definition of the environment that we're currently in, right? So the context, uptrend. And we have different scenarios where, let's say, spread is increasing. And then at the same time, we see that the volume signature is increasing on the same bar. So both result is increasing and effort is increasing. How would it look on the volume equation, right? So volume is increasing. Demand is increasing probably more than supply. And we would be thinking that with the expansion of the price on the healthy increase of the volume signature, supply might be actually going lower. It's still present, but it's diminishing. And demand is not only present, but it's increasing. So effort is increasing and result is increasing. It's a bullish activity and we should expect a continuation of the uptrend. Second scenario, this is where a spread is decreasing, and it still happens on the increased volume signature. So what does it mean? We have a decreasing spread, which means a decreasing result, and we have an increasing volume, which shows us an increasing effort to push the price up. So in other words, there is an increased effort to push the price up, and yet it can do so. Why would that happen? Why would there be some kind of stopping of this progress? Well, it only can happen with the emergence of the supply. So we know that supply is increasing, and demand is still winning because this is an up bar. The close of this bar is higher than the previous bar close. So demand is still dominant over supply, but because supply is increasing, it suggests that supply wants to stop the uptrend from going further up. So therefore, short term, we will interpret this as a potential bearish implication, and short term, we might be expecting some kind of reaction out of this area. Third scenario in the advancing markets, spread is decreasing, and with the decreasing spread, we have a decreasing volume signature. So this is an opposite of the volume signature that we had in scenario number 2. So how would we interpret this? Decreasing spread means decreasing result to the upside, and that happens on the decreasing effort. And here we might be thinking that demand is actually decreasing on the decreasing volume signature. And we probably would be correct. There is a lot of increase of the demand on the previous bar, and then after that, the demand is exhausted, and it's not as much as on the previous bar, so it's going to be shown in the volume signature, and it's going to be shown in the result, in the spread. With the supply, this is a little bit difficult here for us to say from the volume signature. Our natural inclination is going to be that supply is decreasing as well, just because the volume is decreasing. And I think that regularly this is what I would go for. But I also could see how supply could stay at the same level, and that also would suggest some kind of bearish behavior. And also supply could slightly increase from the day when let's say we had the day like this where demand is increasing and supply is decreasing. So imagine that the volume signature is even lower. So this could mean that supply also is decreasing. Well, one way or another, what is happening here is that demand is decreasing, and that suggests some kind of vulnerability to a reaction. So it's interesting how in both cases number 2 and 3, we are suggesting that the reaction should come. But yet, there is a subtle difference here. And hopefully, guys, you already know what it is. And that subtle difference is in the emergence of the supply on the volume signature that is increasing. This is more bearish than the scenario where the volume decreases and supply might be decreasing as well with it. Because that would suggest that, yes, demand is exhausted, but at the same time, so there are no selling. In case number 2, demand might be there, but supply is definitely present and it's increasing. So somebody's selling. And that's kind of like that subtle difference between number 2 and number 3. Number 4, increasing spread and decreasing volume signature. So it's different than scenario number 1. How do we interpret this? Increasing result in the uptrend, we're having a big spread to the upside on the decreasing effort. So this decreasing effort suggests a decreasing of the demand together with the decrease of the supply. And it's this decrease of the supply that makes it a bullish scenario. because it basically tells us that there is no one selling at this point, and therefore supply is not available, and demand is also decreasing, but there is no need for a lot of demand to push the price up. We would refer to this type of action as an ease of movement, and we'll talk more about this. Ease of movement suggests a progression of the price in the direction of a current trend on decreasing effort, where the opposite force, whether it's a supply or demand, is decreasing as well. Last one, number 5. Spread is increasing, volume is increasing, and it's increasing massively. So there is a massive volume signature, and that represents a massive effort to push the price up. And usually we would see this on the chart as like a big volume spike. And we would be talking about the volume spike as the massive increase in volume that suggests that the demand is still there and it's increasing as well. But at the same time, supply is increasing too. It's not only present and it's not only increasing. Relative to the previous examples that we've seen where supply might increase, we are seeing that here an increase of the supply is substantial. And that suggests institutional selling. And with institutional selling, the short-term scenario is always going to be bearish. And usually that's what kind of produces those stopping actions as buying climaxes. This is where a lot of exchange of shares is going to happen. This could be a terminal buying climax. This could be intermediate buying climax. Usually would happen into the overbought, overthrown condition. That's kind of like a preferred scenario. It also could have, we could also see it in the trading range, maybe a climactic type of action into the point of the resistance. And then this could act maybe as an upthrust in that structure. So that's a possibility as well. So let's see if we have any questions on this before we move on. Questions, comments? This should be probably easy to grab as an idea. The only thing here is that I want you to concentrate on is, and obviously I want you to go through this as you go through your homework. I definitely want you to remember these scenarios. All right, so Nailesh is asking, how do open and closed levels impact these interpretations? I think we're going to answer this question, Nailesh, a little bit later on, but this is a good one, so let's keep that in mind. For now, we just want to concentrate on the spread and volume and that relationship. Okay, let's look at the next one. In the declining market, where the context is the downtrend, let's look at all of these scenarios again. They're going to be just a mirror image of the ones that we looked for the advancing market. Spread is increasing, volume is increasing. It's an increasing result with the increasing effort. And when the volume signature is normal, this is just a normal activity in the downtrend action. This is where supply is going to increase and it's going to still dominate over demand. Demand could be very easily decreasing at this point of time. The short-term bias for this interpretation is going to be bearish and a continuation to the downside. Next one, and scenario number 7. Decreasing spread and increasing volume signature. So we're seeing that the spread has decreased significantly, and yet the volume signature still is going up. So we have a case of the decreasing result happening on the increasing effort, where supply is still increasing, but we already see some emergence of the demand. And as demand attempts to stop the downtrend. That's the intention. Just because the volume signature is so high, that suggests that this emergence of the demand could stop the trend from going further down. And by the way, when I say that stop the trend, it could be even a temporary stopping. It could produce just a temporary short-term rally and then continue with the downtrend. Or it could produce a more meaningful move to the upside. It's all contextual. We will have to look at where exactly it happens. But for the short-term buys, we're always going to be thinking bullish in this scenario. We would be thinking that demand is there, it's emerging, it's increasing, it's absorbing the supply. So the downtrend is vulnerable at this point of time. The same would happen on the diminishing spread and the diminishing volume signature. We would be thinking that demand is diminishing at this point. Now, the only difference between this and the previous scenario number 7, is that in scenario number 8, supply is decreasing as well. The overall signature, volume signature, is going down. So most likely, we're going to have diminished supply and diminished demand at the same time. Now, that's actually still preferable to the bearish scenario, just because demand is not there. Demand is poor. So even diminishing supply could push the price further down. Okay, and this is where I see the mistake. So this would be, oh no, actually, that's fine. Okay, so next one, number 9, increasing spread and decreasing volume signature. If we would compare it to number 6, that would be a good comparison. I probably need to shift them a little bit here. Okay, so what do we see on the result? Obviously, increasing result was this type of spread, and then it happens on the decreasing effort. Volume signature goes down. So that suggests both decrease of the supply and decrease of the demand. And that suggests, again, an ease of movement, as the price could move lower on diminishing demand signature, and therefore it is a short-term bearish interpretation. Well, I see the mistake right here. It should be bullish here. It should be bearish. Hold on a second. Decreasing result, decreasing effort. Okay, decreasing demand. Just a continuation. What did I do on the previous slide? I see. Okay, yeah. I think this is the one that should be bullish. Apologies for that. So vulnerable to rally. So yes, bullish. I was thinking like I'm gonna make a mistake somewhere. So that this is it. Okay, so ease of movement, and then the last one is the climactic one, right? So selling climax with the massive volume signature, massive effort behind it. Supply is increasing a lot because of the panicky selling by weekends, but demand is increasing at a much faster rate than anything that we've seen before on the demand increase. So therefore, we're concluding that this is an institutional demand, and therefore it's bullish. A stop in action, reversal, and attempt to rally. Okay, yeah, thank you, Philip. That's great. I like the fact that you like the slides. Yeah, was trying to make them simple but yet very informative. So these are the slides that I want you guys to print out. Again, in this case right here, let me just correct this maybe right away. So here it's actually bullish. Okay, awesome. All right, guys. So something to think about, study, print those out, go through, because we're going to use those a lot in our group exercise. Speaking of homeworks, so this is the first homework from this class. We are going to look into the volume and spread analysis, and what I want you to do is to visualize all concepts from previous two slides, number 19 and 20, on any of the chart. So take all of these 10 scenarios, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, all of them, and find examples on preferably one chart. I am not expecting you to send me 10 charts for different scenarios. I want you to find maybe like one chart that would contain, if not all of them, then the majority of them, and just send this slide to me or chart and identify all of these 10 scenarios. All right, so that's a homework number one. Now let's talk about the laws of supply and demand and effort versus result. So as you know, Wyckoff method has three laws. The first one is the law of supply and demand. And on a very basic level, it just basically says that if you have more demand than supply, then the price will go up. When you have more supply than demand, then the price will fall. And sometimes I think we overcomplicate our volume and price analysis, and we forget about this simple interpretation of the supply and demand and what it means. So I want to point your attention to that. Now, the biggest law for me in the whole methodology is the law of effort versus result. Because effort versus result encompasses both a situation where a supply is larger than demand and the price goes down easily, and when demand is larger than supply and the price goes up easily. But it also suggests a different scenario. It suggests that when we have an increase in effort, an increase and decrease in the result, we are going to have an opposite counter to the general observation of the increased effort conclusion. We will basically say that the price is going to do an opposite thing. And that's what we need to learn. And that's why the law of effort versus result is so important. So how would we measure the effort? Well, obviously we're going to look at the volume signature, and we're going to say that volume is just the representation of the effort. But we're going to be a little bit more specific about the effort. And to me, effort is either increase or decrease in the volume signature. It's not just the volume signature itself. It's the way with which the volume changes, right? So we usually would say, okay, we see an increased volume signature. That would mean that the effort to push the price down has increased a lot. And what do we see? We see some progression, but we also see some kind of stop in action. That suggests that behind this increase in the volume signature, there is some demand signature. And there are some buyers. Because of the extreme volume signature, it's institutional buyers. And actually, we know exactly who was buying Goldman Sachs in 2008 in September. There was some news that came out during that month that Warren Buffett was buying the stock through warrants at a price of 120. Please note that the price went below 60. And he still held on to that position because, obviously, because of the warrants. I understand that. But the CO type of institutions are thinking in a different way than we do. And our task is obviously to understand how they think and how they behave. So, and this is what we're studying in this course. And you could see from this example, as he's buying, the price goes up, and then it absorbs a lot of available supply at this level. So then the next time the price goes down, supply is going down, and someone else is buying. And then all of the other times, again, supply is going down. So there is absorption process that is underway that has started with, Warren Buffett purchases here. And then whatever he absorbed is no longer available in the market, or whatever, other institutions absorbed at this point of time. And therefore, supply is still going to be relatively high to the averages, but relative to the previous spikes is going to be smaller, just because absorption has happened. So what we want to see from the effort is the increase or the decrease of effort. And then obviously when we're going to have an extreme increase in effort, that's usually going to be associated with gaps, with stopping actions, with momentum type of bars, and so on and so forth. We need to understand how we will judge the result, how we would assess the result. Obviously, result will either increase or decrease as well. So I've developed specific measurements, and those are just for our WTC course. I want us to look into the increase or the decrease of a spread or a true range, and we'll talk about this in the next class. We're also going to look into the close, and we will be thinking about two ways of how to address the close. And the question from Nilesh was previously about how would the close or the closes influence our interpretation of the result. So we will look into the close from two perspectives: relative to the daily spread, or a true range, right? So we would be looking at how do we close relative to the actual height of the spread, right? So if we're closing in the upper part above 1/2 of the spread, we're going to interpret this as bullish. If we're closing below 1/2, we are going to interpret it as bearish close. And then we're also going to look at the closes from the perspective of the previous close. So we're going to look at the previous close, and then we're going to make a judgment as to the next close, and we're going to look at the progression of close to close. Because think about closes as the commitment of institutional traders in the direction of the current swing or current trend. So it's going to be extremely important for us to see what's the progress between one close to another. And then the third one is going to be extremely important, and it's going to be somewhat difficult for us to remember that this is something that we will be looking at. It's the intention. And the intention behind the bar is always going to be overcoming some kind of commitment line. It could be a resistance, it could be the previous day bar high. And if we see that commitment above, we're going to say that the intention was fulfilled. If we're going to have a bar that comes close to that, maybe even attempts to commit, but then comes back, we're going to say that the intention to commit above the commitment line or the specific resistance line has failed. So therefore, as a result, we're going to say that intention has failed. We're going to say no, and that would mean that the result is diminishing. And that's a very, very important point. Volume spikes. Well, we kind of discussed those, in the previous two slides, but still again, up spike is going to be on the up bar where demand still dominates the supply, but supply is already increasing and it's producing some selling. The down spike is going to be where supply is going to dominate the demand, but demand is already increasing as well, and it's absorbing the supply at that point of time. It's suggesting the stop in action and the reversal. So again, this is something that I want you to remember by heart. What do we look at in the effort? What do we look at in the result? Especially how do we measure the result? That's extremely important. And then I also want you to understand that in some cases, for instance, in the case of this latest reaction, we are going to have an increased volume signature that would suggest or equal an increased downward pressure. Effort to the downside is increasing. And we're going to look at this reaction and we're going to say this reaction is actually not that big. It's actually in line with the previous reaction, and it's less than the reactions that we've seen before at the beginning of the move. So therefore, we're going to say that the result to the downside has decreased. So what's interesting is that here there is an opposite trajectory for effort in the result. The effort is trying to stay up and is trying to increase and to push the price up. So the effort to push the price up increases while the result is somewhat mediocre. And this is where this law of effort versus result is so valuable. That increased effort on the increased volume signature would suggest an inability to push the price down would suggest that something is interfering. Something is stopping the selling from pushing the price further down. What could it be? Only one thing: buying or demand. Well, not just a regular demand, probably institutional demand, just because the volume went up so high and the public cannot have that type of volume signature. And that's why this law is so important. Out of all of the three laws, if you will remember one, remember this one. Remember the effort versus result. Okay, next question. Should the increase or decrease in volume be compared to local volume signature or mid-long-term levels as well? Now, Lesh, again, really good questions. I like that. It's just that they're a little bit ahead of where we are. So we'll definitely discuss that during our exercise, and we'll definitely discuss both the more local increase and more long-term increase, and we'll just go through this material. Okay, now the exciting part. Okay, so we are starting our group exercise, and I will need a volunteer at this point. So think about this for a second. Meanwhile, our exercise is going to be devoted to both volume and price analysis and price structural analysis. This is the exercise where we are going to combine the knowledge that we got on the price structure and the new information that I'm going to still keep giving you through all of these 5 classes that we're going to have on volume and price. The assignment for this exercise is to identify what is dominant, supply or demand. And we're going to dissect this either with the single bar analysis or with the swing analysis. We, as I mentioned, going to combine the price structural analysis with volume analysis. I want you to make your call on what kind of most probable price action we will have after a point of discussion on the chart that we're going to look at. I also is going to ask you for labeling of Wyckoff phases and events of any of the trading ranges that you see. And most important task as a homework task is going to be to watch the video of this exercise again, excuse me, and to make some notes. And then I want you to email these notes to me. So that's the assignment for this exercise. Now let's look at the chart. So this chart is going to be presented to you like this. There is no reference to the stock that it is. There is no reference to the time. And I've learned that this is only just a distraction for students when I give this type of information. So, and it came to the point that I even forgot what the stock is. I do not know the name. I do not know the symbol. Please don't ask me. But what I'm really concerned about here with this exercise is the way how we're going to analyze this. This is going to be such a foundational exercise. This is something that I want you to be extremely serious about. I want you to be uncomfortable about this exercise because there will be a lot of concepts that we're going to combine. And at first time, it just might, see as kind of like a difficult thing to do. But then something will click and the understanding will come to you. It will emerge in your mind. And that's what we're trying to do with this exercise, to combine the volume and price with the price structure and to start talking about the logic of the analysis, how it flows, how do we analyze it. And because of this logic, I'm trying to create a specific way of how we would be thinking about this analysis. So I want you to think about a bar analysis first, and each bar, not each bar, but each significant bar that I want us to discuss has some kind of number assigned to it. And then after that, and we're going to discuss it from the point of view of the effort and the result, exactly what we went through just now. And then we're going to discuss a swing analysis. So we're going to look at the current swing, so let's say swing number 3, and we're going to discuss, well, relative to this swing, the previous swing to the downside, what characteristics we see, and then the previous counter swing, like this one right here. So we're basically going to compare a swing to a swing. We also will talk about the market behavioral analysis, and that is the behavior between strong and weak hands. And we're going to try to define for each type of the market participant, what are they doing at that spot? And that will create a better understanding for you as to what is happening right now. And then obviously we need final deductions, or rather inductions. Those are going to be on the bias, on the timing, and on the character. And we'll talk about this more as we go through this exercise. But for now, I want you to do two things. We still have maybe half an hour to go. So I want you to, for a couple of minutes, maybe 2 or 3 minutes, and I'll mute myself and I'll go grab some tea. I want you to look at this chart and to analyze the first maybe 3 swings, and we'll talk about this, and hopefully we'll be able to cover even more today in this 30 minutes. But if not, then let's just concentrate on the swing number 1, swing number 2, and swing number 3. And secondly, I want you to say yes if you would like to volunteer and to go with me through this analysis. Thirdly, for the homework, this is the type of the analytical structure that I want you to have. And I want you, as you analyze, and the homework is going to be to analyze the rest. I want you to analyze all of the bars and all of the swings. You don't have to do it all at the same time. You could do this at your own pace. I don't know where exactly we're going to stop today. I don't know where we're going to stop next week. So therefore, just go at your own pace and then compare your analysis to the analysis that's going to be presented in the class. And we'll kind of see how that is going to develop. All right, so for now, 2 minutes break for me, tea break. Meanwhile, I want you to think about the analysis of the first, 3 to 5 swings and the analysis of the bars that are being mentioned. And also say yes if you'd like to volunteer. And we'll go from there. Thank you, guys. All right, guys, volunteers. Maybe someone new. And obviously, I'm here to help, so we're going to go through this together. Okay, 1, 2. All right. Okay, Nalesh, how you doing today?
I'm doing good. How are you
Good,
today?
good, good. Yeah, I just feel like my throat hurts a little bit, but um, I had to stop at many spots, guys, today, so I apologize for that. All right, so let's start our analysis, and let's start with bar number 1, right here. This seems like a conclusion of swing number 1, and let's kind of discuss this bar a little bit. What do we see behind this bar for the result and for the effort?
So the volume is slightly up compared to the earlier close. Uh,
Mhm.
so the effort has increased.
So
Uh,
slightly increased, I would agree. So there's not like a huge effort, right? Because we're seeing it at bar number 1 as the conclusion of that swing to the downside, right? But there is not a lot of increase. There is some increase in the volume signature that suggests what?
Demand is up
Mhm.
slightly, and supply is also, I would say, still present.
Yeah, supply probably either still present, it could be increasing at the same time. I mean, like this is such a bad reference for us on the volume signature, but you're right, it's at the highest point, of the volume here. We see it here, we see it here, we see it here, slightly here. So it's one of the highest increases. But relative to what we see afterwards, of course, this is just not relevant that much. So what do you think is dominating as an effort, supply or demand?
I think demand is slightly dominating, just going by the close of this candle.
Yeah, I think so too. Going by the close, this is usually it's going to be our defining factor for dominating effort. So it closes exactly on the close of the previous bar. But the fact that it traveled up so much, and closed out of kind of like a sprint type of situation, right? Where we might be thinking that this is just a trading range right here, and then the price goes below and then it recovers on the same day. So it's sprint type of action. So that suggests, yes, that demand dominates over supply. Okay, so what about the result? What is the most kind of like obvious result thing that we see? And I don't think that for this particular bar we're going to go into a lot of the details, but still, you mentioned the close, right? The close to the spread is in the upper part, so that's bullish. That's increasing. Close to close, kind of the same. The intention, what was the intention for this bar? What do you think?
To stop the downward movement.
Okay, yes, and also overcoming some kind of commitment level. Where's the commitment level for us?
The close of earlier candle, maybe.
Just all of these bars that are touching this line, right? The support line. So support line acts as that commitment line for us, and we're closing above that. So the intention was to go up and to close above the commitment line, which acted as a support, and we did exactly that. So yes, bullish. And it seems that we could say that the effort to the upside increased slightly, and then the result to the upside also increased. Bullish or bearish?
Bullish.
Bullish. So short-term bullish. And we could expect some kind of rally out of this. Okay, well, the rally happens. It goes into bar number 2. And this is where the whole story, starts to unfold around for this area. So let's think about bar number 2 analysis. Okay, so what is happening with effort?
Increased by a huge margin as compared to the earlier ones. Yeah.
Okay, so effort is increased a lot. Volume is increased a lot. Demand. Is demand increasing?
I would say yes, but the supply too is increased.
Okay, so demand has increased. What is the dominating force?
Demand.
Effort. Yeah, demand still dominates the supply because the price has moved up, closed up. Okay, great. And then what did you say about the supply? Is supply going up or down?
Up.
Up. More than demand?
No, not more than demand.
Not more than demand, but it's going up. So basically we have volume increase, volume spike, with the supply increase, with the demand increase, because demand is still dominant, and with the supply increase as well, but it's not as dominant as the demand. But this emergence of the supply suggests that institutions are doing what?
Buying.
Institutions are selling. Why? Well, because we see two things. What happens? In hindsight, we see that the price went down. So they're definitely selling into the strength of weak hands buying. And then what would be the second most important identification that supply is of institutional quality? And that's the question for everyone.
I think the signature of is too large to be weak hands or public.
Yeah, we know that. We know that there is an institutional volume signature, right? We're just trying to define institutions as selling on this bar or buying. And by institutions, I obviously mean strong hands. What about, let's go further through the list. What about this spread, the result? Now let's discuss the result.
Spread has gone up.
Okay, so spread has increased tremendously. Okay, so close relative to the whole spread
Is bullish.
Bullish, because we are closing on this spread in the upper part of the whole spread. Okay, close to close. So
Is again
from
bullish.
this close to this close. Bullish as well?
Yes.
Absolutely. Yeah, nothing to think about here because we are just from close to close. We're traveling the biggest distance than anything that we've seen before, right? So close to close, and so on and so forth. Okay, what about the intention?
Intention was to get to overcome the resistance, but I think it kind of failed because such a huge increase in volume, but it could not overcome the earlier resistance.
Oh my gosh. Yeah. That's exactly where we want to go with this. Look at this resistance level and look at the bar in question. Huge effort. Think about all of this buying power behind this bar. And yet, if the intention was to overcome the level of the resistance that was created by these two highs right here, where do we close? Because we're closing below that level. We just touch that level and then close below it. What does that suggest?
Institutions are selling probably. There's supply.
Yeah, most likely as the price goes into that resistance level, institutions are selling into the strength of weak hands, and that's what producing that stop in action before that resistance and pushes the close below that level of the resistance. So now we know that institutions are selling and the intention was not fulfilled. So even though spread is increasing, close to spread is bullish, close to close is bullish. But because of the intention and how it has failed to materialize, we're going to say that the result is actually diminishing. And therefore, our effort result signature is going to look like this. Up effort is increasing a lot, and then up result is actually failing, diminishing. So how would we interpret this? As a bullish short term or as a bearish short term?
Bearish.
Bearish, yes. So what's happening here is lots of effort to push the price above the commitment level, and yet we cannot do this despite of all of the bullish characteristics of the spread. So therefore, we would be thinking that institutions are selling. And Philip is asking, we always care about the intentions of the CO or the weak hands also. Yeah, we care about different strong and weak hands, right? So we want to understand where all of these market participants are going to come into the market and how they're going to behave. So from this perspective, bar number 2, we would be thinking that professionals are probably doing mean reversion trade, right? CO is not participating at this point. And then ITFs are not participating in active. And public, Nilesh, what do you think public is doing here?
I think they are participating. They are buying.
Yeah, they are buyers, exactly. So there are bars at this on this particular bar. Okay, so the next thing that happens is bar number 3. And bar number 3 acts as a confirmation for the selling pressure that has come on bar number 2. Why is that, Nilesh?
Because it opened and closed, I think, below the earlier close.
Okay, so close and then open. Right away we see some kind of gap. So that's bearish by itself. Okay. But more importantly, and Dog is asking here, isn't it too early to make that judgment about bar number 2? Wouldn't we just have to wait for the next bar? And usually on a bar like this, Dog would be extremely accurate in stating this, because we would be thinking that this is some kind of momentum type of bar, and usually that momentum bar on that type of volume signature is going to have the increase of the supply, and therefore we need some kind of retest. And we want the retest of that type of action to have specific characteristics. We want this spread, which is the down spread, to diminish. We want the supply to diminish as well. And we don't want to see any violation of the open, low, and we see it right here. So what does that suggest, Nilesh? That violation of the low?
Right. Sorry, I was on mute. Yeah. That violation of low suggests that it's there is no demand.
Yeah. That the demand that was here on bar number 2, that is hidden on the volume spike, it's of poor quality. And we kind of already identified there is some institutional selling coming in. And then the next day, there is no continuation. So that confirms that whatever supply has come on bar number 2 is of institutional quality, and that we are just continuing with the same buys on bar number 3. There are no more buyers at this point, and there are no more sellers. Bar number 2 combined both of them, the sellers and the buyers, both of the camps. And everything was done on bar number 2. Everybody positions themselves, and bar number 3 is just a test, a resolution bar that just tells us that sellers have won. So therefore, as sellers have won, Nilesh, where do you think the buyers are going to have their stop losses?
Stop loss.
I'm going to suggest a couple of places. How about this one? Right below this low, right below this low, and then how about this one right here, right below this low? So, and what's going to happen when the stop losses are going to be hit?
They liquidate and just sell at the market price.
Mm-hmm. So we can't stop. We can't point of entry that bar, and then we can't stop losses, 2 levels. So when the price is going to go through, that stop loss is going to become a market order and it's going to be executed, and that's going to be a sale. Therefore, that's going to increase the level of supply, and the volume signature should go up. So look at the first stop loss level. We definitely see that the volume has increased. And look at the bar number 5, which is the second level. So this is where the majority of the stop losses were. And that's why the volume signature increases here on stop losses. They're becoming the market orders. They're being hit, becoming market orders, and there is a capitulation by weak hands. So right away, notice what happens afterwards. Bar number 5 is that hitting of the stop losses, an increase in the volume signature. Nilesh, what does that suggest for the swing to the downside? Continuation?
Yes.
Okay, but bar number 5 is also very interesting. Let's go through bar number 5. The volume definitely has increased. Do we see an increase in supply just because it was the first move was to the downside?
Yes.
So supply has increased. Do we see an increase in demand?
I would say yes. Demand also increase.
Yeah, absolutely. What is dominating as an effort?
Still supply is dominating.
Probably supply still is dominating demand at this point of time. Some demand came in. We see this from the tail, right? So let's quickly go through the result. So the spread is what? Is maybe slightly decreasing relative to spread number 4, or maybe the same. Close is what, Nilesh?
Close is bearish.
It closes in the upper part of the spread. Look at this whole
Okay.
spread.
Yeah. In the context, yeah, it's bullish.
Yeah,
Yeah.
look at 1/2. So yes, a bullish spread. So some counter. Okay, close to close.
Bearish.
Bearish. Closes below. Okay, and then the intention was to overcome what?
The support.
Yeah, some kind of support level. So, and it kind of closes right on this support level. And if you would take some kind of cluster from this support, from this resistance, we still have not really closed even into that cluster, right? So we're going to say no. So that's on the bullish side. So a very interesting picture here where there are some bullish characteristics that fail, and that is happening on still increased level of the supply and increased volume signature and increased effort. So the downward effort has increased a lot, whereas the downward result has suggested some buying, but basically failed as well, because the intention was to overcome the point of commitment, the point of resistance, and it just closed on the level of the resistance. It didn't really close significantly above that. So that still suggests a bearish picture. Am I correct, Nilesh?
Right.
Mm-hmm. And bearish pictures suggest a continuation of a decline, which we do. And then we go into bar number 6. So let's analyze bar number 6. Volume. What is volume doing?
Volume is up, but not less than still for bar number 5. Yeah.
Yeah, this is an interesting picture because bar number 2, bar number 5, and bar number 6, all of them have the same intention. What is that, Nilesh?
To get the price down, or
To push the price up, right?
sorry, the price.
Not down. Yeah, price up. Yeah. So the bar number 2 is the most successful out of those 3, but again, it doesn't overcome the point of the resistance. Bar number 5 is slightly better on the commitment. It's almost there, but not really. And then, the volume signature goes down. And bar number 6 is not really committing above the resistance that we have there either. But all 3 bars have the same intention. They are trying to push the price up. Now, for us to understand how demand is functioning on those 3 bars, I think we need to talk about the supply first. So what is happening with the supply signature from bar number 2 to bar number 5 to bar number 6?
I think supply is decreasing.
Yeah, supply is decreasing, and supply is decreasing on the way down. So as supply decreasing on the way down, we also see that some demand is emerging, right? And we could say that maybe demand is also decreasing in a way. But yet, let's look at the progress here that we see. If we would take bar number 5 and bar number 6 and compare them. So we're comparing number 5 and comparing number 6. So what could we say about, let's say, the travel of the price from the low to the close?
So it's about the same, I would say.
So from the low to the close, it's somewhat the same. And yet, so this is the result. And yet, what do we see on the effort of the demand? So we're seeing that the demand has diminished from bar number 5 to number 6, right? Do we see that, guys? We're looking at the volume signature, and we see that the volume is going down. So that suggests that both supply and demand are diminishing at the same time. Supply is still somewhat dominant, but demand is going down as well, and supply is going down. So the distance then that the bar number 5 and bar number 6 travel from the low to the close happens on diminishing effort to the upside. So the question is this rally from the low to the close on bar number 6 an easier move to the upside than on bar number 5?
Yes.
Do you guys see that? I want some kind of feedback from all of you guys. Just say something. Yes, I see it. Yes. So we're talking about the distance from the low of bar number 5 to the close, and then from the low of bar number 6 to the close. We're saying that from the low to the close on both bar number 5 and 6, we kind of have this similar result. Yet there is a subtle difference in the way how the volume behaves. The volume goes down, which suggests that both supply goes down and demand goes down. So now we're thinking like, okay, the same result for bar number 5 and bar number 6, and yet it happens on diminishing demand signature. So it means what? It means that it's easier to advance the price. And if it's easier to advance the price, we would be thinking about maybe like an ease of movement where demand is diminishing and yet the price is going up. Is it bullish, Nilesh, or bearish?
Bullish.
It's bullish, at least short term. And therefore, we could expect some kind of rally out of this spot. Okay. Well, here's the rally. It's to the point number 7. And Nilesh, I think that we're going to stop here.
Sure.
Thank you so much.
Thank you.
I hear young Wyckofians there on the background. We definitely love that. So, okay. So, we've discussed it up to bar number 6, swing number 3. So what I want you guys to do is to kind of play around with this. My general assignment here for you is just to go through the whole chart and just to analyze it bar by bar, swing by swing. Again, you don't have to do everything. probably in the next class, we're going to stop somewhere here or maybe here. I don't know exactly where we're going to stop. It all depends on how, the class is going to unfold. So therefore, just go at your own pace. Maybe as a point of reference, let's do everything until point number 25, and that would be fair. I don't want to overwhelm you as well. But I want you to analyze, yes, I want you to analyze all of these bars, all of these swings. I want you to think about the market behavioral analysis. I want you to finally deduct something as to, like at bar number 9, what is happening that, concludes, let's say, this environment and suggests that we're going to go up. I want to hear your reasoning. I want to understand how your mind thinks on this. So, and you will be ready, to discuss all of this, and it's just going to go a little bit faster. You can use this format, please do so, and you could send me, different slides on, let's say, different bars, different swings, and so on and so forth. But not necessary. You could just show me what you, in any other different ways that you want to show how you analyze all of the bars and all of the swings. I would definitely accept that. I'm just giving you maybe an example of how you could do that. All right, and this is going to be the exercise for the next 5 sessions or so. Again, this is a very important exercise. We didn't have a lot of time today, but even those 30 minutes for this exercise, please listen to this again, make your notes, send those to me. So quite a few, homework assignments. Again, I'm not insisting on everybody, going through the homework. So just do it at your own pace, and, prioritize. I would say that the priority is this exercise, obviously. But if you have time to do the volume and spread exercise, do that as well. All right, guys. Good class, a lot of material today. I'm glad that we are kind of like getting on with this exercise. Sorry and apologies that I was not feeling that well today. I think I'm feeling better now by the end of the class, surprisingly. So I'll see you all next week, and have fun with the homework. Thank you, guys, and bye-bye.